Hello and welcome back to Chapter 5, Job Costing, and your last learning objective, number 7. What the heck do we do with the under or over applied overhead costs, and what's the journal entry look like to close out that balance, close out that clearing account? Okay, so let's take a look at an example. Let's just go hands-on right at the beginning. So say we have actual overhead for the year of $650,000 with a total of 170,000 direct labor hours worked on jobs. So actuals. How much of total overhead was applied to the jobs during the year? So let's take a look using the predetermined overhead rate of $4 per hour. All right, so two things we have actual overhead occur. So let's just go actual manufacturing overhead, and that is going to be 650,000. Great. And then what did we have for applied overhead? How much did we actually apply to the accounts? And that would be our 170,000 direct labor hours times by the predetermined overhead rate of 4. So we actually applied 680,000, which means that we over applied 30,000 because we have the applied minus the actual. So we over applied 30,000. So then the question will be, what the heck do we do with this extra 30,000? Well, there's a couple different opinions on this. So current accounting standards in Canada, one of them being International Financial Reporting Standards, says that unallocated over expenses are recognized as an expense in the period in which they are incurred. In the periods of abnormally high production, the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above costs. So this means that the balance in the manufacturing overhead account must be treated in one of two ways, depending on whether it was under or over applied during the year. If overhead was under applied, the remaining balance is closed out to COGS. So we just take the balance. So if it was over applied, if it was under applied, then that means that there weren't enough costs there. So then we need to just take that and zero it out to the income statement. However, if overhead was over applied, that means that the balance allocated amongst the remaining balance needs to be allocated to work in process, finished goods, and COGS proportionate to the amount of the overhead applied during the period in ending balances. So what does that mean? Okay, so what would this look like? It would look like if we had manufacturing overhead, we had actual costs of 650, but we had applied 680. That means that our clearing account is in a credit balance. So in order to do that, it's in a credit balance because we've over applied the expenses. We need to make it a debit, which means that we debit manufacturing overhead and credit cost of goods sold. So to visualize that for you, that means that we would we would debit manufacturing overhead by that 30,000 that was over applied, and we would credit cost of goods sold to reduce the cost of goods sold. So we're just clearing it out because manufacturing overhead applied throughout the period was greater than manufacturing overhead costs incurred. It was over implied. All right. So now let's assume that the overhead cost applied in ending work in process was shown as below. And let's assume that we are to allocate it to work in process, finished goods, and cost of goods sold, proportionate to the amount of costs incurred because, just going back because it was abnormally high production, and so the amount of inventories are now above cost, so abnormally high. Let's also just assume, because under GAAP of ASPE, the other GAAP in Canada, we can have a choice to allocate either expense through cost of goods sold or allocate proportionally. So either way, we are told we need to do it proportionally. What the heck do we do? Let's take a look at how we do this in Excel. So we still have overhead costs applied, and we need to allocate it as intended. So our debit is going to be the same up here. And now our credit is going to be to work in process inventory. It's going to be to finished goods inventory, and it's going to be to cost of goods sold. But how much do we allocate to each? And that is the question. So we would take, I'll just copy paste this, our ending balances and allocate this 30,000 proportional. So let's just whip 68, finished goods, 204, cost of goods sold, 408, and we have a total of our 680 here. So then what's the proportional balance for each? So take this and you get, I don't know, 10%-ish. Take finished goods and you get 30%-ish. It is 30%. I'm just joking. There's no decimals. So here we have 10, 30, and 60. Quick check. These all add up to 1. So we've allocated 100%. Great. So then we would take our 30,000 and we would allocate 10% of the 30,000 to work in process. We would take our 30,000 and allocate 30% to finished goods, and we would take our 30,000 and we would allocate 60%. Whoops. Why are you not mathing? All right, we're going to delete that and do it again. Oop. I mean, maybe. Yes. All right, take our 30,000 times it by 0.6, and that equals 18,000. And so that those are the amounts that we would then credit. So reduce the costs. Of course, I was trying to be a little bit lazy with copy paste, copy special, values only. Perfect. And this is to have manufacturing overhead. So both are same, just different methods. Either way, manufacturing overhead needs to be cleared out of the 30,000 that we over applied there. So here's a hint. Sometimes students will be confused as to if it's over or under applied. So if that is you, I would suggest going back to your T accounts. You're going to debit the manufacturing overhead account for all those things that you actually do incur, because debits are actually incurred on the balance sheet. And then your application is what you're applying to. You just happen to be applying it as it goes. And at the end of the year, have you applied too much or too little? And that will be too much is you're over applied and you have a credit balance. To clear that out, you need to debit it. But if you are under applied, then you would have a too many costs that weren't applied. So you would have a debit balance that you would need to credit and then allocate accordingly. So I always like to go back to these T accounts. Alrighty. Quick check and then we're done. Let us take a peek. So consider pausing this video and coming back and seeing how you did. All right, so we have Tiger Inc. They have actual manufacturing overhead. So actual manufacturing overhead of $1,210,000. And they have a predetermined overhead rate of $4 per machine hour, $4 per machine hour. They have a total of 290,000 machine hours during the period. And so their manufacturing overhead, was it over or under applied? Okay, so let's see. Applied manufacturing overhead is going to equal our 4 times our machine hours actually incurred throughout the year. Right, you don't like it when I use punctuation. That's fine. So 1.16 million. So we applied this, but we incurred this. So that means that we under applied because we had more cost than we actually applied of 50,000. So under applied of 50,000. Great. So if you said B, 50,000, you would be correct. Fabulous. All right, so let's close this out, people. Really good work. We did a bunch of things. We understood first what is a job order cost versus a process cost, where job order costing is used in situations where the organization has many different products or services that are unique and identifiable. They could be furniture manufacturers, hospitals, and legal firms. We then differentiated them from process costing, where the units of production are homogeneous, such as flour, cement, and toilet paper. We then learned about the predetermined overhead rate and the fact that we are going to determine that at the beginning of the term, at the beginning of the year, before any costs are actually incurred. And that is so that we can apply manufacturing overhead as it is incurred. So we determined what the predetermined overhead rate was using our allocation base, and then we're applying it through the actual allocation base used by each job. And then, because it's going to be wrong, right? What we applied is almost always going to be different than what we incurred. We need to figure out, are we going to close it all out to the cost of goods sold? Are we going to allocate it to work in process, finished goods, and cost of goods sold? Or last choice, are we going to carry it forward to the end of the year and either close it out to cost of goods sold or allocate it to work in process, finished goods, and cost of goods sold? Regardless of what you do, at the end of the year, it has to be gone. It's a clearing account. Manufacturing overhead doesn't actually exist as far as any year-end financial statements or supporting trial balances. So that has to be cleared out, either all to cost of goods sold or allocated proportionally to work in process, finished goods, and cost of goods sold. People, you did it. We are officially halfway through the course. That's incredible. I say officially, I mean through the course material. Of course, you still have your quiz. You still have lots of practice to do, but pretty dang cool. You've built upon a lot of learning, prior learning from 1101, your introductory financial accounting. You've also really learned about the building blocks, our product costs, our indirect costs. You've learned a lot of terminology, relevant, non-relevant, and we've used them in a couple different ways. We're going to continue on using those building blocks in different ways in the second half of this course. But until now, I hope you have a great day and we'll talk to you soon.